Hey everyone, welcome back to Corporate Decoder, the place where we make sense of corporate filings, and today we're diving into Verona Pharma's latest financial story. Get ready for some big news because Verona Pharma just got a massive buyout offer. Verona Pharma is a biopharmaceutical company, and this report covers their financial performance for the quarter ending June 30, 2025. It's a really interesting read, especially with that huge acquisition by Merck looming. This is the official report covering the period from April to June of 2025, so it gives us a snapshot of how Verona was doing right before that massive Merck deal was announced. First off, let's talk about the elephant in that room, the acquisition by Merck. This report lays out a ton of risks related to it. They're saying the deal might not happen, or it could take longer than expected, and if that happens, it could really hurt their stock price and their whole business. It's basically a giant question mark hanging over the company right now. Verona Pharma is a UK-based biopharmaceutical company focused on respiratory diseases. They already have one drug on the market called Ohtuvayre, which was approved in June 2024 for Copy D. Now let's get into the numbers, starting with their balance sheet. Think of this as a snapshot of what the company owns, what it owes, and what's left over for the owners. As of June 30, 2025, Verona had nearly $438 million in cash and equivalents. That's a good chunk of change, up from about $400 million at the end of 2024. This is important because it means they have money to keep the lights on and fund their operations. On the debt side, their term loan significantly increased from about $120 million at the end of 2024 to over $242 million by June 2025. That's a big jump in borrowing. And the shareholders' equity, which is what the owners have in the company, saw a nice jump from around $204 million to $278 million. This increase is mainly due to their profits, or net income as they call it, in the 2025 period. Now let's look at how they actually performed their income statement for the 3 and 6 months ending June 30th. This is the big story here. In the 3 months ended June 30, 2025, they had nearly $103 million in product sales. And for the first 6 months of 2025, that number jumped to almost $174 million. This is their first commercial product, Ohtuvayre, and it's clearly generating significant revenue. But with that sales success comes cost. Their selling, general, and administrative expenses shot up from about $49 million in the first half of 2024 to over $141 million in the first half of 2025. That's a massive increase, largely due to building out their sales and marketing team to support Ohtuvayre. For context, that's more than a 180% increase in these costs. They're spending a lot to get this drug to market. And the bottom line, for the 3 months ending June 30, 2025, they actually reported a net income of almost $12 million. This is a huge turnaround from the same period in 2024, when they had a net loss of over $70 million. For the first 6 months of 2020, reduced to about 4.4 million NAS compared to a massive loss of nearly $97 million. Recent quarter is a very positive sign. Let's look at the cash flow statement. It shows us where the company's cash is coming from and where it's going. For the first 6 months of 2025, they generated nearly $90 million in cash from operations. This is a massive improvement from the $27 million cash use in operations in the same period of 2024. This shows they're getting much better at generating cash from their core business activities. Financing activities show how they raise or pay back money. In the first half of 2025, they brought in about $18.4 million from financing. This is way down from $163.7 million in the first half of 2024. The big difference is that in 2024, they took out a substantial term loan, which they've now mostly paid down or modified. Looking at their liquidity, they believe their current cash plus anticipated sales and loan funding will cover their needs for at least the next 12 months. However, they also acknowledge that if the Merck deal doesn't go through, they'll likely need a lot more money to continue developing their products and commercializing Ohtuvayre. The crucial point here is that Ohtuvayre is their only approved product. Its commercial success is absolutely vital for their future. If sales don't meet expectations, or if they can't get it approved in other countries, it could severely impact their financial health. They also have a collaboration with Nuance Pharma for Greater China. It seems there's a dispute brewing there about a buyback option, which could add another layer of uncertainty. Now back to the Merck deal. The risks here are significant. The report details how the announcement alone could disrupt their business, affect employee morale, and make relationships with partners shaky. Plus, if the deal falls through, they might have to pay Merck a hefty termination fee around $100 million. That's a serious potential blow. One of the biggest risks they highlight is their limited operating history. Until this recent quarter, they've been consistently losing money. That $11.9 million profit in the last quarter is great, but it's just one quarter. They need to prove they can consistently make money. Their debt situation is also a factor. With that big term loan, they have increased financial obligations and restrictive covenants that could limit their future actions. It makes them more vulnerable to economic downturns and puts them at a disadvantage against competitors with less debt. Intellectual property is the lifeblood of a pharma company. Verona relies heavily on patents to protect ensifentrine, but enforcing and maintaining these patents is tough and expensive. If they lose patent protection races, competitors could easily jump in. And of course, the stock market, their ADS price can swing wildly due to things completely out of their control, like market sentiment and economic news. That means investors could see big gains or losses very quickly. I also admit their commercial capabilities might not be enough to handle Ottavari's success. Building out a sales force and distribution network is a massive undertaking, and there's a real risk they might not do it effectively. Finally, there are the legal and regulatory hurdles. They're operating in a heavily regulated industry, and any misstep with healthcare laws could lead to significant penalties. This includes strict rules on how they market and sell their products. So what's the verdict on Verona Pharma? They've clearly hit a major milestone with Ottavari's sales performance, showing they can generate revenue and even turn a profit in a single quarter. That's a huge positive sign. However, the company is still very much in its growth phase, accumulating losses overall and taking on significant debt. The looming acquisition by Merck presents both a massive opportunity for shareholders and a significant risk if it falls through. Their future hinges on Ottavari's continued market acceptance and the successful navigation of that Merck deal. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.